Hello, this is the 13th time for What Would Peter Lynch Do? Exploring the wisdom of the legendary investor Peter Lynch. We got a fantastic question from you, our listener, that really hits home for so many people just starting out. You asked us, I am a freshman in society. Should I buy a house first? Or should I invest in stocks first?
Yeah, that's a big one. A really fundamental question.
It really is. It's not just about money, is it? It's about stability, your goals, how you actually build wealth over your life. So our mission today is to take the material you share these insights based on Peter Lynch's thinking and really dive deep. We want to explore his perspective on this specific question. Not just what he said way back when, but how his wisdom applies to your situation right now. It's about pulling out the key ideas to help you navigate this choice.
Absolutely.
Yeah.
And it's a crucial question, especially now, incredibly timely for anyone starting their financial journey. The analysis you sent over, it does a great job laying out Peter Lynch's original view, mostly from his classic book, One Up on Wall Street.
Yeah.
But, and this is important, the material also looks at how that advice needs maybe tweaking for today's world. Because things have definitely changed since he wrote that book. It's not just repeating him, it's understanding the principles behind the advice.
Okay, yeah, let's get into that. So back when Peter Lynch was writing, his view was pretty straightforward, wasn't it? He often leaned towards buying a house before putting serious money into stocks.
He did. He really saw it as a foundational step, almost like getting your base set before you go climbing the mountain of investing.
Which might sound a bit odd if you're just thinking about stock market returns, right? Purely chasing gains.
True, but his reasoning, as laid out here, was incredibly practical. It wasn't just buy a house because it's nice. He pointed out some powerful advantages a house offered, things that were crucial for building wealth, and maybe even more importantly, for becoming a better, more disciplined investor in the long run.
Okay, so what were those core reasons?
Well, the first big one the analysis mentions is what it calls psychological stability from the illiquidity paradox.
Illiquidity paradoxes. Sounds a bit fancy.
It does, but the idea is actually pretty simple. Think about stocks. Prices flashing all day, every day. You can buy, you can sell, boom, with a click on your phone.
Super easy. Too easy, maybe.
Exactly. That constant easy access creates huge psychological pressure, especially when the market dips, right? For new investors, that fear kicks in, and what happens? Panic selling. Just dumping everything at the worst time.
The classic mistake wrecks your long-term returns.
Precisely. So the very ease of trading stocks, kind of ironically, makes disciplined investing much, much harder. Now, houses, they're the opposite. You don't see the Zestimate changing every second.
Thankfully not.
And buying or selling, it's slow, it's complicated, it's expensive. You got realtors, lawyers, mountains of paperwork, it takes time. You're just not going to sell your house because the market had a bad week.
No way.
So this difficulty, this illiquidity, it acts like a built-in safety rail for your behavior. It protects you from those emotional knee-jerk reactions. It forces you really to think long-term, stops you making those terrible mistakes driven by fear or, excessive greed, that friction. It's actually a good thing for your financial health.
That's a fascinating way to put it. The difficulty actually helped you. Okay, what was the next point Peter Lynch made?
The second key reason is about safe leverage without margin calls.
Okay, leverage, using debt.
Right. Look, building serious wealth often means using some form of debt or leverage to control assets bigger than your initial cash allows. But doing that in the stock market, borrowing from your broker margin debt that's playing with fire, super dangerous.
Why is that?
Because if the market tanks, your broker can hit you with a margin call. They demand more cash right now. If you don't have it, they force sell your stocks, usually at terrible prices, and you can lose everything. Wiped out.
Ouch.
But a mortgage,
Yeah.
that's also massive leverage.
Right.
You put down, say, 20 grand to buy a 100 grand house, that's 5x leverage.
Yeah.
But Peter Lynch saw this as much safer.
Oh.
Here's the key difference. As long as you make your monthly payments, the bank isn't going to call you up and force you to sell just because house prices dipped a bit.
I see. The structure is different.
Totally different. He saw it as probably the safest way to borrow big money for building wealth over the long haul, provided you could comfortably handle those payments. That's the caveat.
So it's big leverage, but without that immediate catastrophic risk you get with stock margin. Interesting. What about saving?
Good segue. That leads straight to the third benefit, the forced saving system. When you pay your mortgage each month, part of that payment goes towards the principal. It chips away at the loan.
Right, reducing what you owe.
And directly increasing your equity. your actual ownership stake in the house.
Mm-hmm.
It builds your net worth.
Okay.
Now, think about saving, especially when you're young. It can be really tough, right? Life costs money. There are always things you want to buy.
Definitely. Discretionary saving takes discipline.
A lot of discipline. But a mortgage payment, that's not optional. It's a bill you have to pay. And because part of it is that principal repayment, it effectively acts as a powerful, forced saving system. Every single month, like clockwork, some of your income goes towards building a tangible asset. You do that consistently for 10, 15, 20 years. You're building a solid foundation of wealth almost automatically, without needing that constant willpower that voluntary saving demands.
It turns a necessary expense shelter into an asset-building machine and enforces discipline. Makes sense.
Was there a final reason? The fourth main point Peter Lynch stressed was the inflation hedge and use value.
Inflation hedge, keeping up with rising prices.
Exactly. Historically, good real estate, especially in decent locations, tends to go up in value over the long term, often faster than inflation. So it helps protect the purchasing power of your money.
Stocks can do that too, though.
They can, absolutely. But a house has something unique stocks don't offer. It's use value. It literally provides shelter, a basic human need. Stable housing.
Right, you have to live somewhere.
Think about paying rent. That money, it's just gone. Poof, you're paying someone else's mortgage, building their equity.
It's true. A sunk cost.
Whereas mortgage payments, they meet that same basic need for shelter while simultaneously building your own asset value. So a house is kind of unique. It's both an investment asset and an essential consumption good. That dual role is a big plus.
Okay, that paints a really clear picture of Peter Lynch's original thinking. Psychological protection, safe leverage, forced savings, inflation hedge, and use value. It's a strong case based on, practical realities of the time. But let's pivot back to you, the listener, today. That logic sounds great, but just applying it literally, buy a house first, period. That feels, really different now, doesn't it?
Oh, absolutely.
Especially with house prices compared to what a freshman in society is earning. The material you sent us digs into this reality check.
It does. And it's crucial. That original house first mantra, while the underlying logic holds up, can be incredibly difficult, maybe even financially dangerous, if you just apply it rigidly today without thinking.
Yeah.
The challenges the analysis points out are pretty stark.
Like what?
Well, first, the enormous income versus price gap. House prices, especially in desirable cities, have just exploded compared to how much entry-level salaries have grown. Saving up even a basic down payment.
Yeah.
It's not something you can easily do in a few years, like maybe you could back then. It could take a decade or more.
Yeah.
The barrier to just getting in the game is so much higher now.
Okay, that's the entry problem. What about once you're in?
Then you hit the second challenge, the potential for a crushing loan repayment burden. Because prices are so high, you need massive loans. We're talking huge sums of money.
Hundreds of thousands, easily.
Right. And the monthly payments on those massive loans, they can eat up a huge chunk of a young person's paycheck. That severely limits your cash flow for everything else. Day-to-day life, emergencies, saving for other goals, and crucially investing.
You're house poor, basically.
Exactly. The analysis calls it the end of cash flow. If almost every dollar is going into the mortgage, you have zero financial flexibility. That creates its own stress and really limits your options down the road.
Which leads to the third problem, I guess.
Directly. It's the lost investment opportunity cost. If all your financial energy for years and years goes into saving for that down payment and then servicing a giant mortgage, you might have little or nothing left over to put into the stock market.
So you miss out on starting early.
You miss out on the magic of compounding. Time is maybe the most powerful weapon an investor has, especially a young investor. Delaying getting into the market for 5, 10, 15 years because you're totally focused on the house, that means potentially sacrificing decades of growth that could have started, even with small regular investments.
Okay, so the core ideas from Lynch stability, leverage control, saving discipline, use value, they still make sense. But the way he suggested achieving them, just buy the house, is much harder, maybe even counterproductive for many young people today because the market's just so different.
You've nailed it. The context has shifted dramatically.
So does that mean Peter Lynch's wisdom is just outdated? We just ignore it?
No, not at all. And this is where the modern reinterpretation in the analysis is so smart. While the literal instruction, buy a house first no matter what, might be unrealistic or even bad advice today, the spirit behind it, the philosophy, that's maybe more important than ever.
How so?
Well, the adapted approach presented is basically First, secure stable housing, then do serious investing.
Yeah.
It's about understanding the why behind Lynch's advice, that need for stability, and finding a practical way to achieve that why in today's economy.
Okay, secure, stable housing. Let's break that down.
Right, it's part one, as the analysis suggests. Secure stable housing at a manageable level. Notice the key phrase, at a manageable level. Stable housing doesn't automatically equal buy a house right now at any cost. Not if that means crippling yourself with debt.
So what does it mean practically?
The goal is shelter that gives you psychological peace of mind. And this is absolutely critical. Protects your cash flow. Doesn't drain you dry. The analysis gives some real options for achieving this today. Option one, maybe the best strategy if it works for your family, is living with parents.
Reduces costs massively.
Exactly. Minimizes housing expenses, frees up cash. It creates a golden time where you can save aggressively and start investing.
What if that's not an option?
Another path is using government support, affordable housing programs, maybe things targeted at young people or first-time buyers. These can offer stable rent or lower purchase costs, again, protecting your cash flow.
Okay, and if you do decide to buy?
Then the advice is to be realistic. Consider a manageable house. Maybe it's smaller than your dream home. Maybe it's a bit further out. The key is that the monthly payments should still leave you room to breathe, to save more, to invest, rather than going all in with debt. That FERT approach the analysis mentions, which leads straight back to that end of cash flow problem.
Right. So priority one is stable, affordable housing, whatever form that takes. Get the foundation secure without breaking the bank. Makes sense. What about investing during this time? Do you just wait?
No, that's part two. Do parallel small stock investing. And the analysis stresses this is a must-do. It's crucial.
Why not wait until the housing is totally sorted?
Because you absolutely should not put off all investing until you own a house or have some huge pile of cash. Investing isn't just something you read about, it's a skill. You learn it by doing.
Get your feet wet early.
Exactly. Start early, even if it's with small amounts. Think about using, genuinely disposable money, maybe a couple of $100 a month. Money you could technically afford to lose while you're learning.
What kind of investments?
The suggestion is to keep it simple and diversified. Consistently put those small amounts into broad market ETFs index funds, tracking something like the S&P 500 or the NASDAQ 100, like the ones mentioned. This isn't about getting rich quick before the house. It's about starting the investing journey. Harnessing time.
Because time is the biggest advantage for a young investor.
It's huge. Starting early, even small sums, benefits massively from decades of potential compounding. But just as important is the psychological training.
Experiencing the ups and downs.
Yes. By riding out market swings with small stakes, you learn those vital lessons firsthand. You learn not to panic sell during a drop. You learn not to chase crazy rallies fueled by hype.
Not to sell in fear, not to chase buy.
Exactly. That hands-on experience is like basic training. It prepares you mentally to manage much larger sums later on, calmly and rationally.
Okay, this updated approach feels much more practical for today. Secure affordable housing first to stabilize your life and cash flow, while starting small, consistent investing to learn the ropes and leverage time.
Precisely. It takes Peter Lynch's core idea, get a stable foundation before taking big investment risks, and adapts it. The literal buy house first might be unrealistic or even damaging today if it means crushing debt. But the philosophy deal with housing instability first to get psychological and financial stability that's vital. Think about the dangers. Crippling all-in house debt leaves you vulnerable. But so does reckless stock gambling when you're worried about next month's rent. Both are bad paths.
So the smart strategy balances both.
Yes. For a freshman in society, adapting Lynch's wisdom means, first, prioritize securing manageable, stable housing, whatever that looks like, for you to protect your cash flow, get that base secure. Then, from that stable platform, consistently invest small, manageable amounts in quality, diversified assets. Let time and compounding do their work. I will say a word from Peter Lynch today, and I will say that this principle is connected not only to investment decisions, but also to life wisdom.
That's a really interesting connection. It makes you think, doesn't it?
Yeah.
This idea of securing a stable base camp first, whether that's affordable housing like we discussed, or maybe a solid education, or even just a reliable support network. Getting that foundation right before you launch into something ambitious or risky. It doesn't just apply to houses and Starks. It applies to careers, projects, maybe even relationships. What does building your stable foundation look like for your goals? Something to definitely mull over as you start out. Well, thank you for joining us for this deep dive into Peter Lynch's wisdom and how it fits or needs adjusting for today's world. Really helpful stuff. See you next time.
This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.